Coming up today, stocks finished mixed ahead of the jobs report. Why chip stocks are falling after hours. Are we about to see another yen crisis? The latest stock NVDA just invested in. A preview of the jobs report tomorrow. The bullish signal for small caps. A look at the US dollar and its valuations. The latest moves from Russia and the big move from MasterCard with crypto. I've got a good one for you today, guys. You don't want to miss it. Let's go. And as forecast yesterday, bit of a low range, quiet trading day as the market's on edge, waiting for the big jobs report tomorrow. US economy expected to have generated 160,000 new jobs in the month of August, with the unemployment rate expected to come in at 4.2%. S&P 500 sitting at 5,500 here. Market definitely a little soft and spotty across market color. You can see a number of key sectors. S&P and NASDAQ itself underneath the 20-day moving averages, and both the NASDAQ and the Russell underneath their 50-day moving averages. Market's been consolidating for a few months, and we're still in the top half of that range. But in a bit of a change of late, there was a rotation into big tech today. As a group finishing up over 1%, when all the indices were pretty much down on the day. And stick with me because I'll tell you why they're selling off after hours, along with semi-chip stocks, as the AI trade is still under pressure. We'll also be talking about the weakness in the bond market today, 10-year having lost key support at 380 here, and also be diving into the US dollar, doing a bit of technical analysis on multi-time frames and showing you its valuation against other key currencies and how I specifically plan on taking advantage of that. And so anybody interested in running a diversified portfolio, I'm sure is going to find a lot of value in that segment later on in this video. I'll also touch on Tesla and why that's rising today, and we'll take a look at PayPal and the latest post on X from its CEO, which I found really interesting. And I'll also show you my valuation on PayPal a bit later on as well. First, let's just dive right into pretty much the last of the big earnings releases from big tech, and that's the under-discussed Broadcom. Given its market cap of $700 billion, doesn't really get talked about a lot. However, it is a key chip maker, and they just gave a weak forecast after reporting earnings per share just slightly ahead of expectations, along with revenue. And so once again, the market's not being kind to any company that even comes in slightly soft on their guidance, like we saw with NVIDIA last week. We're seeing again today with Broadcom. Even though they beat on their numbers. Just going down to a 5-minute chart after hours as I speak, stock is getting whacked, down 6.6%, which is also causing a little bit of a sell-off in NVIDIA. And it's going back to the daily chart on the semiconductor ETF, selling off a little bit after hours as I speak as well. And so a big part of the AI trade is semiconductors, and that sector is definitely stumbling, just like the robotics and artificial intelligence ETF been consolidating for a few months here as well, not doing anything too exciting. And you can think of the smallest and hottest stocks in a sector as kind of like the canary in the coal mine. And one of them in the AI theme, C3AI. They reported earnings yesterday as well, and even though they came in better than expectations, stock still got whacked, with the CEO even coming out today and say the market is misunderstanding the numbers. They reported a quarter loss of 5 cents per share compared with a forecast of 13 cents, with their revenue forecast pretty much coming in line with expectations. And so the reaction in the stock market's got the CEO stumped, and he's coming out telling everybody they've got it wrong. And there's a look at the daily chart on C3AI, which is actually lower on the year from where it started. Did look like there was a big buy the dip off the open today, but still finished down 8%. And so the point is, if this stock market's been led by the AI theme, the AI boom, and we're seeing some weakness in the market's reaction to earnings, in the price action and trends taking out support, that's not a good sign for this bull market, because it may have been the AI boom that helped us avoid recession last year. And wouldn't it be funny if all this hype about advanced GPUs, AI chatbots kind of just fades away, we all got a bit too carried away with it, and then the market's pretty soon like whatever, and the market loses its excitement and optimism for that. What does that do to the entire bull market that's been led by AI? However, we do have a rotation going, so even if AI and big tech could potentially go into a bear market, NVIDIA's already technically in a bear market, off 20% from highs, a lot of other AI stocks as well, and we could still see these other defensive sectors like consumer staples hold up, and REITs on the hopes of lower interest rates. Markets definitely rotated to them over this last month, just as value stocks are starting to look a bit better than growth stocks, and looking at both the Vanguard growth and value ETFs. So chip stocks are definitely pulling back under pressure here, and in the medium long term, still that China risk as well. They go into Taiwan. So many of the American chip makers, Apple and the like, have a lot of their manufacturing and fab work coming out of Taiwan. Taiwan Semi, still the biggest supplier of chips in the world. However, Wall Street analysts are still bullish on the sector and on NVIDIA. Still seeing articles saying buy the dip, take advantage of any weakness. But the biggest bull thesis being that the capex from the hyperscalers is set to continue. So further weakness in semis and AI, definitely a key risk for the market, or at least looks to be cementing the change of guard with the sectors that are leading this market. However, we've got other big risks out there, like the Japanese yen. And what we saw on the 5th of August last month, the conditions are still there for it to be repeated. And that's because we've got G10 global central banks all pretty much in sync now and beginning their monetary easing cycles. At the same time, the Bank of Japan is raising their interest rates and indicating they could potentially raise them further off rock bottom lows they've had for years as they attempt to normalize interest rates in their economy and prevent inflation from getting out of control. In fact, one investment manager that predicted the yen shock does see another one coming, Arif Hussain, which he describes the Japanese yen trade as the San Andreas fault of finance, predicting more market volatility ahead as the interest rate differential between Japan and other economies makes the yen carry trade less profitable. Large funds that borrow in Japanese yen to invest in Japanese stocks, US stocks, often doing so with leverage and other people's money, get margin calls from their prime brokers and have to rein it in, causing those big sharp repricings, just like we saw last month. And one key indicator and price action I monitor for the yen carry trade is what I actually used to do it in myself back in the mid-2000s. That's long the Aussie dollar, short the Japanese yen. That was August 5th there, that capitulation. Big hammer candle, kind of bounced, traded up to the 50, now we've turned back down, and so the trend is still down here. I can see in my trend strength indicator, there's some pretty strong and persistent momentum in this market. And funny enough, that's coinciding with the price action in Japanese stocks as well. Looking at Nikkei futures, traded over there. Just 2 sessions ago, they had a pretty sharp pullback, down 4.6% for the day, on heavy volume back below the 50 as well. So it's very possible we could be setting up for another retest of this level on both the Nikkei and the yen currency pairs. Just like I said back then, we could get a retest and potentially a double bottom. If the Bank of Japan comes out and gives any more indications that they want to hike soon, I may just get things moving enough to hit some margin calls. However, it's not all bad out there. Still got plenty of stocks rising. Tesla coming back into the focus, rising again today. On the back of an upgrade from Morgan Stanley, reiterating Tesla as their top pick from their analyst Adam Jonas. Got a price target at $310 a share, mentioning full self-driving FSD will be available in Europe and China in Q1 next year, and that could point to a boost in their profits, with FSD costing $99 a month with a high margin. And this is part of the big bull thesis for Tesla. Long-term FSD, full self-driving, and robo-taxis, if they can pull it off, which of course is a big if. Nonetheless, that's all it took for the market to get excited, pushing the stock up almost 5% today, back above its 50-day, and it's starting to look a bit better again, especially compared to some other large tech stocks out there like Microsoft, trading a bit weak this last couple of months. Same with the consumer-sensitive Amazon, also trading a bit soft, doing a bit better Apple, as we await the details on their new iPhone 16 due out next week as well, along with CPI inflation data on Wednesday. So next week will be another important one after we get through the big jobs report tomorrow. But in some bullish news today for the AI trade, there's a little stock called Applied Digital, soaring 60% today on the back of news NVIDIA is investing in it. And they're a data center operator coming out of Dallas, Texas, that has received $160 million in financing, in which they said will strengthen its financial position, helping to bring its offerings to market at scale. Among these projects are the company's current build-out of one of the world's largest data centers and development of an additional 300 megawatts of data center capacity. Markets certainly enjoyed that news. Look at that move today. All the day traders out there jumping on board. 149 million shares traded, still a small stock, $5.37, market cap still around $1 billion. And so it looks like they are getting some momentum in their revenue. Free cash flow still not at all there and still richly valued, still likely to be a highly volatile stock for a long time to come. But interesting to see NVIDIA invest in it and kind of start a portfolio of investments. Another one being SoundHound AI, which they invested in a few months back. It too got increasing revenue. Really interesting story with SoundHound as they're helping to take voice AI mainstream. Just looking at their website here. Their products can be used in restaurants, with drive-thrus, kiosks, automotive industry, smart devices, hospitality, contact centers. No doubt set to be the future, where most of the customer support we'll be dealing with will be a robot. Whether SoundHound AI is the leader in that field or not is still yet to be seen. However, the potential is certainly there. They've already got big branded customers, investment from NVIDIA, and so no doubt it deserves a premium valuation. Given its trailing 12-month revenue is only $55 million, market cap at $1.6 billion, meaning it trades over 30 times sales. So you can kind of think of these stocks as like lottery ticket, and the market kind of prices them as such. Hugely volatile. For example, 52-week range here, 1035 down to 168. That's why for some investors, just putting 1 or 2% of their portfolio in stocks like these can sometimes make sense if you're willing to accept that you might lose the entire amount. However, if you just do the old famous coffee can strategy, shove your stock certificate in a coffee can, forget about it for 5-10 years, you may come back to a nice surprise. Because I can imagine if SoundHound AI does pull off their vision, it's not hard to see in 3-5 years from now them having a market cap of 50, 100 billion or more. But of course, that's a best case scenario. It could easily take 7, 10 years or longer, even if they do lead the field of voice AI. And just moving back to the macro for a bit, we got some more weak economic data today. ADP private payrolls rising by 99,000, much lower than 141,000 economists were expecting. However, still a mixed picture, because on the other hand, we got services PMIs coming in better than expected and still in expansion territory. It's where a lot of inflation's come over the last couple of years, is from the services sector. But what's getting the market worried, especially the bond market, is the softening in the jobs market. We can see that with revisions to jobs opening data, the lowest we've ever seen. In other words, the government agencies have been feeding us really good headline prints in the media this last year, and then coming out a bit later on when everyone's forgot about it and revising them down. And we saw that a few weeks back with the entire jobs market, which they overstated by 30% for the last year. Bit of a whoopsie. Interestingly, we're seeing a spike in the amount of jobs cuts coming out of the technology sector. May have something to do with why tech stocks have been weak of late as well. However, not seen a huge spike in initial weekly jobless claims. Just looking at 2024 here in the blue line for continuing claims, over here for initial claims, and you got 23 in the gold. And just to look at 2019 and 2018, which were pretty good years for the economy and stock market, following similar trends. However, the point is there's just a lot of FUD out there, fear, uncertainty, and doubt, because there is definite sign of softening in the jobs market, and that softening can quickly fall into an acceleration as the unemployment rate can often spike. Seen a slump in manufacturing, haven't seen the best rebound in China, and the fact is most consumers in America, at least 2/3, are still grappling with that really high embedded inflation they've experienced over the last 3.5 years, in which they're in a worse position than they were back then. As the top 10, 20% who own assets, especially the top 1%, have never been richer thanks to huge government spending, inflating everything. Not just your groceries, but also assets, has made asset owners the wealthiest they've ever been. But for most consumers, they're already in a recession. They're pulling back their discretionary spending. And now we're getting signs that they could be getting laid off. It's going to put a lot of people in a really tight spot. And we can see that downtrend in the monthly job growth in the US economy, with it expected to come in at 160,000 new jobs created in August. We even got JP Morgan's top economist saying the Fed should cut rates by 0.5 point this month. Markets certainly price in a strong possibility of that as well, with Michael Farrelly going on to say, we think there's a good case that they should get back to neutral as soon as possible. We think they should hurry up their pace of rate cuts. If you wait until inflation's already back to 2%, probably waited too long. And that's been the main criticism of the Fed, is they've been too data dependent instead of balancing out. That was some forecasting, and they've copped quite a lot of criticism for not already cutting. And just looking at market pricing, and not only Fed fund futures, but also the bond market, certainly given a strong possibility the Fed could start off with a 50 basis point cut. We have seen them do it before. After the tech bubble burst in the early 2000s, again in 2007, at the beginning of the subprime mortgage crisis, and they did do an emergency 50 basis point cut in March 2020 for COVID as well. So I wouldn't rule it out. And I mean, look at that price action in the 2-year government bond yield. That is swiftly down. Really big change over this last 2 months. Hard to imagine. Just 2 months ago, we were trading around 480. Markets chopped off 100 basis points in that time. Big dive in the short end, helping us to bring the bond yield curve slightly uninverted yesterday, but still weakness in the 10-year as well. So bond market, pretty convinced the Fed's going to have to drastically cut rates pretty soon, and there's a real chance of a recession occurring some point in the next 6-12 months. Still not really seeing the stress in the high yield corporate bond market though. Price action holding up pretty good, along with spreads on top of treasuries, still at low levels, 3.35. And so it could go either way. Back in 2007, when the Fed cut rates by 50 basis points, the market actually rallied. Loved it, but that was pretty close to the top. If we see a bad jobs report tomorrow and further signs of weakening in the US economy, J. Powell may just scramble and do a 50 basis point cut, and that could spook the stock market that's already trading at lofty level. But just moving on to the macro, back to a bullish signal we got for small caps today, and that was Trump calling for slashing corporate tax rate for domestic producers only, proposing American companies that produce their goods inside America pay a tax rate of 15% to help accelerate the reshoring we've seen over the last couple of years, move away from relying on China for everything, getting back to domestic production. And why this could be bullish for small caps is because, for example, the S&P 500 gets almost half of its revenue from outside of America, but also does approximately 60% of its production outside of America as well. Think like Apple, Nike, Walmart, other companies like this that get all their goods made in China or India, something like that. Whereas the Russell 2000, they derive about 80% of their revenue from America. They're more domestic companies, and they do about 60% of their production onshore. So of course this is not guaranteed to get through, just as he's not guaranteed to get back in the White House. However, it is a potential upside for small caps, which would be good for small cap investors like myself. Also interesting to see today, he also proposing a role for Elon Musk in the government, also calling for the states to have their own sovereign wealth fund. And that's basically an investment fund run by the state in which they use some of their revenues to invest in assets all around the world, with Norway having done that the best, taking their excess revenues from their oil reserves, investing it in stocks all around the world. Total fund size 1.3 trillion. Then you've got China and a lot of other Middle Eastern oil-rich countries doing the same, as they're worried about a future in oil and are diversifying their wealth. It would be interesting to see the states with a sovereign wealth fund could help out the finances of the US government long term, as these portfolios do spit off dividends that can be used to service the economy. And so it's interesting to see Elon Musk really lean into this, posting today that he looks forward to serving America if the opportunity arises. He doesn't want any pay, no title, no recognition. He just wants to get the work done. Going on to say he's never been materially active in politics before, but this time I think civilization as we know it is on the line. So pretty big call there, and he seems to be really motivated to become a part of this, as he's been really critical of the government for a little while now. Even saying yesterday, government spending is driving America to bankruptcy, as we just got news. The US government spends $3 billion a day just on the interest expense to service its debt. And we also heard yesterday, the Government Accountability Office estimates the federal government loses between 233 and 521 billion annually to fraud based on data from 2018 to 2022. That's 2% of America's GDP stolen every year, with Elon also pointing out what could have been done with that money to better serve the American people. He also spoke in favor today of Javier Milei and the good job he's doing over there in Argentina, saying Milei's being in prosperity. Back to Argentina, and why I've seen that big turnaround in Argentina this year, and why I've invested in a stock there as well that's already doing well right out of the gate, is that Javier Milei has a rare combination of having both brains and guts, being that he's a trained economist and he's not afraid to speak out and do what's right. And like he said, only entrepreneurs can create wealth, not politicians. Politicians spend our wealth, and they do a pretty bad job at it. And so can you imagine this kind of cost-cutting and wiping of departments in American government, just like he did in Argentina? Just getting rid of agencies completely, cutting government down to size, letting entrepreneurs drive the economy, which has already brought down inflation and bringing prosperity back to most people. Imagine seeing this type of stuff in America. And we've even now got woke elitists like Mark Cuban coming out and pushing back against the proposal to tax unrealized capital gains, along with increasing the capital tax rate for people like him worth over 100 million. And it's funny how their political dialogue changes when things start affecting themselves personally. And that's because even though, as a bigger hypocrite as Mark Cuban is, he probably understands what one of the founding fathers of the United States, Thomas Jefferson, said, and that most bad government has grown out of too much government. You could think of the government as kind of like a referee in a sports game on the field, kind of overlooking different sides, enforcing some rules, but still allowing freedom within boundaries, still allowing their teams to choose who they want to choose, play the way they want to play, and not have to give up half of all their wealth and income to the referee, who's just supposed to overlook and regulate things. But with modern day governments, the amount of referees is starting to approach the amount of players on the field, and bogged down with so many rules and tax just becomes too hard to do anything. And in the States at least, it's really not the state and local governments that have been racking up the debt. They've actually been pretty well managed. It's all happening at the federal level. Federal net debt as a percentage of GDP, late last year, almost 100%. We haven't seen that since World War II, in which the US government had to spend big to finance the war. However, what was the excuse this time? And so that reckless abuse of capital and record spending is really what's threatening the US dollar long term, and in my opinion, the strength of the entire West as well, against a rapidly advancing BRICS, or at least something spooking the US dollar over the last couple of months. And so I thought on today's video, we'd take a look at the US dollar technically and fundamentally against some other currencies out there, and what I'm doing to hedge my own wealth against a continued fall in the US dollar should the government continue going in the wrong direction. And so first, let's just start off looking at the technical picture in US dollar index futures. And this is right when Biden pulled out of the race and Kamala Harris shot up in the polls along with her tax proposal, which a lot of Wall Street said, in tandem with falling bond yield, may have added some pressure to the dollar as well. However, just looking at a long-term clean monthly chart of the dollar index, which is basically the dollar against a basket of other developed currencies from around the world, definitely at a big key level here. Not only the psychological number of 100, but it's a point where the market's turned numerous times before in the past. And what's interesting, just zooming out again, and we'll switch over to 3-month chart just for some more easy viewing, is ever since the Federal Reserve and the federal government went on a money printing and spending binge, since late 2008, the US dollar was actually down at 75, has actually strengthened that time. You could think of that as a huge divergence. The strength of the dollar versus the government's finances, which have gone the other way, in terms of debt to GDP, along with a threat to the US dollar as well. Not only from within, but from BRICS. That's accelerated, central banks getting into gold, the big pursuit of de-dollarization. The US dollar could very well be overvalued here, given the sharp change in fundamentals over the last 15 years. No doubt that's helped the price of gold rip up, especially in the last couple of years. And like I regularly say, that's one way to hedge against the US dollar. However, what are some other ways that I'm doing as well? Well, to properly diversify and at least hedge your wealth is to hold assets that are denominated in different currency. And you don't have to invest directly in foreign country exchanges to do that. You can invest in American Depository Receipts, ADRs. And that is companies that are from around the world that trade on their local stock exchange that also list in New York. And so if their currencies appreciate against the US dollar, that makes the ADRs more valuable, all things being equal. So if the business improves and the currency improves, it's just another tailwind for the stock price, the ADR that's traded in New York. And that's one area I've been leaning lately in my own portfolio. Buying international, cheap, defensive, dividend-paying stocks that are listed as ADRs in New York. And one way you can use to value currencies is by using what's known as the Big Mac Index, common commodity around the world, the same ingredients, and basically that just converts the price of a Big Mac back into US dollars. And so we can see a list here of the Big Mac in different countries. However, that's just looking at nominal levels. What you want to do is look at the Big Mac Index adjusted for GDP. So for example here, a Big Mac costs 11.1% less in Australia than the United States at market exchange rates. Based on differences in GDP per person, a Big Mac should cost 2.6% less. This suggests the Australian dollar is 8.7% undervalued. So that's taking into account the GDP per person and normalizing it to give you a bit of a rough estimate of its valuation. This is just one way to do it. There's other ways like terms of trade and things like that. The valuations of currencies is a really murky kind of academic field. It's not as straightforward as most other assets with cash flows that you can discount against a risk-free rate. However, according to the GDP adjusted Big Mac Index, got some currencies like Australia, which is interesting because it's a commodity country. And the Aussie dollar has been weak for over a decade now, but could be nearing the end of a stage 1 accumulation. And so Aussie commodity stocks, which you can still get good valuations, good dividend yields, they could be a good hedge against a weakening US dollar, whether you own them directly or ADRs. Another interesting one showing up as undervalued, South Korea, quickly growing an advanced economy, doing good work in tech, AI, robotics, just like Japan. Using the GDP adjusted Big Mac Index, South Korean won could be 21% undervalued. There's a look at a long-term 3-monthly chart of the South Korean currency versus the US dollar. It too also looking technically supported, potentially forming a base here. Chinese yuan, a bit more complicated since it's not a free floating currency. They fix their currency. However, the Big Mac Index still suggests that it's 25% undervalued. Other ones, Philippines, Vietnam, South Africa, India, Japan, and the most undervalued being Hong Kong and Taiwan. Interesting to see the yen though, still being as 40% undervalued. Big Mac costs 43% less in Japan, around $3.19, versus the average cost in the States, $5.69 US. And that's why the yen carry trade could have more unwinding to do. And this could be something that goes on for years in markets. Just look at how oversold the yen versus the US dollar is. Haven't seen these levels since the late 80s. Bank of Japan keeps increasing interest rates. Very well just may have seen the bottom in the yen dollar. And that could give another tailwind for holding assets denominated in the Japanese yen. Because not only is the US dollar potentially significantly overvalued, US stocks could be as well. Not only within its own stock market, when looking at the top 10 stocks of the S&P 500, with a current PE of 28 versus the remaining stocks, current PE of 18. We haven't seen a gap like that since the late 90s when all those tech stocks crashed and small caps and value stocks outperformed over the next 10 years. The good news is we have global earnings estimates over the next 12 months curling up for both China, Japan, Europe, and emerging markets. Of course, the States has led earnings growth the last couple of years thanks to mega cap tech. But not only do we have improving global earnings, we're at a great starting valuation. Looking at the PE of all world stocks versus S&P 500, currently more than 2 standard deviations below its average, with the average PE on international stocks being 13 versus that of 21 for the S&P 500. So if that earnings growth gap closes between the States and the rest of the world, very well likely could see the valuation gap close as well. And there's quite a big valuation gap between China and America. Look at the difference in the 12-month forward PE ratios. 23 in the States, 7.8 in China. Of course, States deserves a premium valuation, but does it deserve to be 3 times as that of the second largest economy in the world? With some forecasts, they will be the biggest economy in 10, 15 years potentially. And there's a look at a long-term 35-year chart of the share of global market cap as a percentage of the world. US absolutely dominating, 64%. A lot of people don't realize Japan was actually the biggest stock market in the late 80s. Huge blow-off peak, never quite recovered. They're down at 5%. And we've seen a sharp divergence over the past 30 years in Europe, declining as a percentage of the world market cap, and emerging markets in the green increasing, although they've been weak the last couple of years thanks to China. My money is on emerging markets overtaking Europe, and that's where I'm actually putting my money as well. I don't actually own any European stocks, but I do when it comes to emerging markets. And there's a look at the long-term Chinese large cap ETF, which, like a lot of international markets and currencies, looks to potentially be bottoming and moving off that base. So like I said, I'm worried about the potential sharp devaluation of the US dollar, along with the valuation gaps, and so I'm increasing my exposure to international stocks, especially emerging market stocks. And if you invest directly in those stocks or in ADRs, you can get the currency tailwind as well. Another way to diversify out of having all of your assets denominated in the US dollar, if that's something you want to do. And so it looks like the banking cartel maybe have lost control over the price of gold. The rest of the world ganging up on them. Interesting to hear Russia massively boosting their daily gold purchases. 601% monthly increase. Seen that with the Chinese as well. Turkey, other countries going back to the shiny metal as a store of wealth, as they too are rushing to get away from the US dollar and kind of take away the US government's leverage to issue sanctions on them and freeze their US dollar assets around the world. Another direction the US dollar has been attacked is from cryptocurrency, Bitcoin. Now seeing the world's second largest credit card provider, MasterCard, enabling non-custodial crypto spending in a new partnership. So basically there's already heaps of payment options out there where you can load some Bitcoin or crypto into an account and spend it. However, this one gives you all the benefits of spending your own crypto that you're self-custody to, where you act like your own bank. If you've got it offline in cold storage, you can basically connect that to a MasterCard and spend all around the world, which is very appealing because anytime your crypto is held in a third-party wallet or custodian, it's kind of like just putting your money in the bank. A lot of people don't realize your savings account is pretty much an unsecured loan to your bank. They'll farm it out at a higher rate in mortgages and credit cards. And whilst there is some backstops from your government, depending on your country and what type of account it is, like JP Morgan said, gold is money, everything else is credit. And that's because you're relying on a third party to be a good custodian of your assets. However, when you've got gold buried in the ground, along with crypto, other things like wine, jewelry, collectibles, art, cars, physical wealth properly stored, then you're the custodian. You don't have any third-party risk, apart from if your wife wants to leave you and take half. Hopefully not, right? But that's why it's always good to have at least a portion of your wealth in physical items that you have control over, instead of having everything being looked after by third parties that you just have to trust. And sticking to the payments industry, interesting to see Alex Chriss, the CEO and president of PayPal today, post on X, we're ushering in a new era for customers, making it easier and more rewarding than ever to shop with and pay with PayPal anywhere, anytime, both in stores and online. Now expanding to in-store so customers can have a richer and more rewarding experience. And there he is there, slapping his PayPal card at a retail checkout. And so PayPal is an interesting setup. Absolutely slammed the last couple of years. Came out with all these woke policies. And just like every other stock that comes out with these woke policies, they typically get hit hard as they alienate half of all their customers and investors. However, the fact is PayPal business has been growing that entire time. They're head and shoulders above the rest when it comes to online payments. Been doing it the longest. Company was started by Elon Musk and Peter Thiel, and you can kind of think of it as the bank of the internet. And so at 31 billion trailing 12-month revenues and a market cap of 73 billion, I'm not surprised to see my stock fair value indicator has been undervalued. My trend candles indicator just gone back to green here on the weekly chart. I think it's a really interesting setup, especially now they're getting more into physical payments. Could really challenge Visa and MasterCard, which they have an advantage of being much more embedded in the online payment ecosystem, and being able to pay someone according to their email address still works really well, just like it did 25 years ago, and why eBay acquired it and spun it off. And now eBay itself, not even half the size of PayPal, 28 billion market cap, but online classifieds are not going anywhere, so it is a pretty solid stock, and it's not a bad valuation itself at the moment either. Moving on, there's your economic calendar for today. Initial jobless claims coming in a little better than expected, but not on ADP employment change. Eurozone retail sales, worse than expected, contracting. There's the services PMIs, better than expected. Crude oil inventories coming off sharply. And tomorrow we'll get to see how the Eurozone economy has grown in Q2, expected to be 0.6%. But tomorrow is the big one. We'll be getting the unemployment rate from Canada and also non-farm payrolls from the States. The US economy expected to have created 160,000 new jobs, market expecting an unemployment rate to be 4.2%. I think it's going to come in at 4.2 or 4.1, which at 4.1, the market may swiftly price the chances of a 50 basis point cut. However, if that came in at 4.3, I think the market would get worried, especially 4.4. However, it's going to coincide with the amount of new jobs created as well. If that comes in hot or weak, we could see a sharp repricing tomorrow. And going into it, Fed Fund futures pretty much given a 60-40% chance on 25 basis point cut and 50 basis point cut. And that's where I stand at the moment as well. However, I'll update my odds on a 50 basis point cut tomorrow after I dive through the jobs report and all the data there. And just looking at the VIX one-day index, we could get a bit of a move tomorrow. Option dealers bumping it up here to 21.69, bit of backwardation, saying we could be in for a bit of a spicy Friday tomorrow, with the market already soft going into it. So I guess we'll just have to wait and see what that print is first thing in the morning and all the reactions we get in the market. So come back to the Click Capital channel and I'll break it all down for you again and let you know everything that's going on out there. Thanks very much for tuning in with me today, and I'll see you again tomorrow. Cheers.